Now, one thing I want to be clear about today is I'm definitely not here to sell you any kind of certainty. Anyone telling you that they know exactly where the markets are going to be in 12 months or 16 months, 18 months, 24 months, they're lying or they're guessing or they're just throwing enough shit at the board and they're going to see what sticks. Okay? It's not what we like to do here. I like to Good afternoon, ladies and gentlemen. We'll give it a minute before we crack on. I know it's a bit of an odd time for most of you out there at the moment, 10:30. But just in light of everything that we've got to get done today, busy day, and what I've got going on behind the scenes this afternoon, I thought it was better to push up the session by a couple of hours and get it started earlier, shall I say. But yeah, hope you all had a good Christmas. I know I did catch up for a quick hipfire session yesterday. So many of you have already had my best wishes for Christmas, but if you haven't, here they are. We've got an enormous amount to get through today, guys. Loads and loads and loads of stuff. So we will get cracking on. Just give it another minute and we'll get started with that. Good to see you though, James. Glad to see your name in the room. Hope you had a nice couple of days off in Christmas time, or if you still are, enjoying the holidays. I still don't know what my plans are for tomorrow for New Year's Eve. Yeah, cool. No worries. I mean, loads of people are. Loads of people, I think, that are never here. They end up private messaging me saying, "Yeah, I'm in on a daily basis, but I'm never on. I'm never officially online." So there is that to contend with. You have I have no idea when people are on or not. Excuse me. It's all good. It's all good. I like to know if you're online or not. Sometimes haven't seen you on officially online for a while, so it's good to see you. Good to know you're there. All right. Well, let's get going then. Of course, this session is being recorded, and all things are on and working absolutely fine. Just I've triple checked this session to make sure everything's working fine and coming through okay, because there's no way I want to not be able to release the recording of this one, as it's going to be very valuable. I should hope. So we will get cracking on. As I said, this session is going to be all about the 2026 year ahead projections. This is my thoughts and feelings towards 2026, what we may end up seeing throughout the year in regards to the financial markets, but also touching upon things that aren't directly relevant to the markets as well. Geopolitics, for example, even some things that go into behavioral changes in consumers and how that's going to shape the markets. It might not all be absolutely directly relevant, but it will affect the markets in a big way. And that's quite a lot of the stuff that gets missed out usually in these kind of projection sessions that happen around this time of year. So we're going to go through. I'm going to share the inside of my brain and what's going on upstairs. And then you guys can use it as a reference point or go back to it as in when you need. And after the session is done, it will be recorded. It will be saved, uploaded, and then it will be sent out to you all this afternoon. And so you have access to that throughout the year ahead. And then we can use that as Either, oh, we got that right, or we can pretend that we didn't see it and got it wrong. So let's set the scene. Now, before we get into, of course, the charts, numbers, and the projections themselves and stuff, which will be coming at the end of a long piece of, or a long discussion, a very thorough, in-depth discussion, I want to zoom right out because 2026, it's not just going to be another trading year. I don't believe. It's going to be a reset year. Now, we've spent the last few years ultimately moving away from free money and it's now gone into restrictive policy. We had stimulus, which then turned into policy tightening, and we had a lot of speculation, which ultimately led to survival. Now, thinking about that word survival, it was only maybe a week ago, a couple of weeks back, or a week and a half ago or so, where I was applauding you all, applauding every single person inside this trading community and on the outside of the trading community as well, ultimately, that has managed to make it throughout this year because it has been a year of survival. It really has been. The markets have been all over the place. We've had a massive increase in micro trends, micro ranges, micro market structures. We haven't had massively trending markets. The final figures are pretty much there for the FX market that suggested that 88% of FX trading assets have been stuck in a range in 2025. The US indices are something upon themselves, of course. We've had the AI bubble continue to expand, which don't worry, I'll be touching on later down the line in the session. But apart from the enigmas, the outliers, most of the markets have been in a big range, and it has been a case of survival. And now we find ourselves entering the phase where markets have to seriously figure out what normal even looks like again. So if you think, you draw back on history, I actually started trading in 2009, I think it was. So, or maybe even the end of 2008, which was just at the financial crisis. So of course I was too young to be significantly affected by the crisis itself. My parents, they were the ones that had to bear the brunt of it. But I started my career in the markets, and I say career lightly, I was a bedroom trader. At that time, I was learning, I was going through the ropes like you guys are now at that point in time, where the markets were having to enter that phase of what looks normal. And it's not to say that, it's not to say, what I'm not saying here is we are at the end of a financial recession, but we're at the beginning of one, or we're at the beginning of this major market cycle that we're just getting involved in. So we've come out of the end of a big bull run where we had excess stimulus being flooded around the markets, loads and loads and loads of free money, which is now turned to restrictive policy and fiscal policy tightening, monetary policy tightening, which is what, just drawing upon what I've just mentioned, a moment ago. So this is where the markets now have to figure out what normal looks like moving forwards over the course of the next maybe 3, 4, 5 years, however long it's going to take. And that process is rarely ever clean. It's not a smooth transition. It's pretty uncomfortable, generally speaking. Now, one thing I want to be clear about today is I'm definitely not here to sell you any kind of certainty. Anyone telling you that they know exactly where the markets are going to be in 12 months or 16 months, 18 months, 24 months, they're lying or they're guessing or they're just throwing enough shit at the board and they're going to see what sticks. Okay? It's not what we like to do here. I like to give, generally, if I'm going to put my name next to something, it's going to be a bloody explicit number, and be it right or wrong, I will put my money where my mouth is. I've done that time and time again, right here, right in front of you. So that's the kind of guarantees that you can get from me. What I'm definitely going to give you is structure, probabilities, and a framework so you're not going to be blindsided when the narratives shift. Okay, and that's what you can get. That's what you're going to get being here on a consistent basis throughout 2026. And this session is about understanding the forces that are ultimately going to shape the year ahead. And it's not about, chasing the news or chasing the headlines when it happens and always having to be, ultimately 2, 3, 4, 5 steps ahead, steps behind. Now, we're going to think now first of all about how markets actually move. Now, most traders out there, they think that markets move because of the news and only because of the news. Now, I'm actually a big advocate for fundamentals and how they shape the markets, but I really like sticking to that word, shape the markets. But they're not the thing that just moves the markets. Now, as we have managed to broaden our horizons and managed to take on new education and new understandings of how things move commercially in the markets, we know that news is, most of the time, it's actually the excuse price uses to move to where liquidity will already exist. Now, markets ultimately move because large participants, large individuals need to rebalance their portfolios. Now, thinking about portfolio rebalancing, what does that actually mean? So ultimately, this means periodically the buying and selling of assets in your investment portfolio. And this is to return it to an original target allocation. So if you think to yourself, you have, stocks, the FX space, and commodities, which is what we here at the UTC is what we like to focus on. And let's say you want stocks at 50%, you want FX at 25%, you want commodities at 25%. So if you end up at the end of a year with stocks at 70% and the others diminished, then you need to rebalance that, and you need to be constantly working towards your original asset allocation, your original target asset allocation, which is very, very important when you are considering that the size of these firms are in the hundreds of millions, if not billions of dollars. So it's about disciplining your investments by selling high performing assets like, it's self-explanatory, by selling your high performing assets, your assets that have done very, very well for you, and then buying the underperformers. So if you're struggling in something, you want to be taking the profit from one and putting it into another. And that is the very, very layman's terms of balancing your portfolios. Now, we also need to think about things like managing risk and, threshold-based rebalances as well. So managing risks obviously comes into play a hell of a lot. It prevents your portfolio from becoming, too risky or too conservative, and you need to balance that element. And you also have the, threshold-based rebalancing as well, which is when an asset class deviates from a certain percentage from its target. So all of this takes place, and it takes place, throughout the year, but a great deal of it takes place at the end of a year and the beginning of a year as well. In the last financial quarter, in the first financial quarter, at the end of a year, and the beginning of a new year. Now, the second thing, the reason why market move is because capital needs to rotate. Now, I use this term quite a lot, capital rotation, and I assume that you know what it means, but I'm not absolutely guaranteed. So capital rotation refers to a strategic movement of investment funds from one asset class or sector or whatever else to another. And this is usually in anticipation of a change in market conditions or economic cycles. And that the ultimate goal is to maximize those returns and manage risk by moving money into areas expected to outperform. And, obviously, and out of those expected to underperform. So, for example, if things are very, very cheap in the US and the interest rates are low, then you want to put your money in the US in investment opportunities in equities or something else. because those industries are going to boom. Business is going to boom because costs are low. But when interest rates are incredibly high in the US, you want to be taking your money away from the United States and putting them in somewhere else that has low interest rates or another less expensive investment opportunity. And this is that in a nutshell is capital rotation. Now, there's some pretty key aspects, big key aspects of capital rotation. You need a proactive strategy. It is predominantly driven by market cycles. So that's, economies moving through predictable stages. It's expansion, slowdown, contraction, recovery. Different sectors thrive at different stages. And so you get a lot of capital rotation around that. You have, and then of course you've got what's the one that we're always talking about, like every single day? Profit taking. Profit taking. And this is rotation, often occurs after an asset or whatever has experienced a strong run, becomes what you guys may deem to be overvalued or overbought or whatever. And then you have the investors selling their orders and taking their profit, which then spikes the markets and lets the markets go back down again. And we see this all the time. We see this at the end of a big run in a single 24-hour window. We see this every Friday afternoon. You see this at the end of a financial quarter. You see this at the end of a financial year. So this happens constantly throughout the year. So there's lots and lots of different stages of capital rotation. So yes, and then the third reason why markets move, which is the risk needs to be reduced or increased. Now, I don't need to go into that, so to speak. I mean, it is self-explanatory. The risk is constantly changing. The risk in the markets is constantly changing. The risk around the world is constantly changing. So they have an entire floor in their buildings, which are just risk management. It's purely just risk managers constantly looking for the details between the lines at where the major risk is coming from, how to protect their money at all costs, and also make money at the same time. That's the risk manager's role. So ultimately, everything else is just storytelling out there. So from the gurus and whatever own. So this is why markets can rally on bad news and dump on good news as well. It's not irrational. It's, even though in the moment we'll all get pissed off and be like, what the hell's going on? But actually, it's not always irrational. Sometimes it is positioning, because that's how they move money. One of the biggest mistakes traders make is assuming that if the outlook is good, then the prices must go up. And I think this has been incredibly true over the course of the last year as well, in 2025. I mean, it's always been true, but if you think about it, we've had almost never-ending bad news for the first 7 or 8 months of the year, and the markets in the first 3 months dumped, and then after that rallied like like it had gone out of fashion. So we had huge market rallies, and all we heard was negativity from the Fed. So again, if the outlook is good, it does not mean that price has to go up or go down. Because institutions at the end of the day, they don't think like that. They think that if everyone already agrees the outlook is good, then who's left to buy at the end of the day? And then this sets up the distribution psychology nice and early. Now, thinking about the macro backdrop. So ultimately, the world we're trading in right now and heading into 2026, we have global growth, which is slowing down a lot, but it's not collapsing. Inflation is lower, but it's not gone. Rates are high, but as we've come to realize, as we've been informed, they are likely to continue coming down. But if you think about it, that's a really bloody awkward combination. It's not bullish enough to justify any blind risk on, but it's not bad enough to justify any panic selling. So this creates where we've been, I would say, for the past at least 8 months. And this creates range-bound macro environments. So we've got, very, very short trends. We've got trends that managed to stay in line for maybe a maximum of a couple of weeks, maybe a month actually. Let's be fair. Maybe the longest term trend that I've managed to actually successfully navigate this year was 4 weeks. That's the longest term one. So that's not great. It's not a great trend. That's the longest term one. The rotations have been a lot sharper. Yes, so we've had a lot of significant knee-jerk reactions coming out of the blue when we've reached, let's say for example we have, let me bring up, so for example, a lot of this stuff going on here for a moment. So if we take, for example, this area of price action, right, between there and there. This bit of price action started on September of this year. Okay, so September, October, November, December, and now we're coming into January. It's a long time. And we've had these moves down and then these big moves back up again for months at a time. Not days at a time, not weeks at a time, but months at a time. And even before this, we had these sharp rotational structures and stages of the market. I mean, the markets haven't really gone anywhere. I mean, we're going back April, May, January is there. January, February of this year. So the entire year, and we've had this just trade ultimately sideways. I mean, we reached a low down there on April of 2025. We're currently trading there at the moment. We started the year January, we started the year about there. So we've had a slight reduction in US 10 years, but not significant, I would say. And we've had these big capital rotations, which happen constantly, over and over and over again. Yeah, so we have had that continuation of the sort of ranges and stuff, and then of course we've had to be patient. I mean, how many times have you all heard me say, patience is the key? We need to be patient. Just be patient. Let's not rush into this process. We need to be patient. I mean, I sound like a broken record, but that really is the shape of 2025 and now moving into 2026. Patience is the edge now. It's not just another cliche traders saying you need patience to be successful. No. I'm not giving you any of that bullshit. I'm being serious. Patience is going to be your edge in 2026. It's already been part of our edge in 2025. It's going to be ever more our edge in 2026, because 2026 is likely to be a year where context matters more than the conviction. Now, excuse me, I'm going to have a big gulp of water. All right. Let's talk about the Fed. Let's talk about central banks, power, pressure, politics, and all that good stuff that's going to shape our markets landscape, but that no one really pays too much attention to above the baseline. The Fed, and I've said this so many times as well over the last year, the Fed is walking a tightrope. It really is, or they really are. Cut too early, and the inflation expectations, they're coming back. Cut too late, something's going to break. And unlike previous cycles, debt levels currently mean that the margin for error is extraordinarily tiny. So yes, we would not want Fed Chair Powell's job. And we've said that before, but I mean, the man's looking tired. And no surprise. So I want to talk about debt servicing and debt servicing costs in plain language. Now, at higher rates, the governments are going to pay more interest. Now, the US Treasury is the government's banker and accountant. So when federal spending exceeds revenue, which is a budget deficit, okay, I want to repeat that. When federal spending exceeds their revenue, a budget deficit, that's what it's called. The Treasury then borrows money by selling US Treasury securities. And these can be like bonds, notes, and bills. And they sell them to investors all around the world. Now, the debt servicing is the act of paying the required interest on those securities and repaying the principal, the original borrowed amount, when they mature. And then the Treasury uses the tax revenue to make these payments. Now, the Fed's role is to manage the monetary policy to promote maximum employment and stable prices, which is ultimately controlling inflation. And it does that by influencing interest rates and the overall money supply in the economy. They've had an incredible job of trying to do this, of course, when the government has churned out billions, trillions of dollars in stimulus. And this is something that I've spoken very, very highly about. And it's something that we're going to be paying the price of. We are right now, and we will continue paying the price of for years to come. Years to come. The damage that has been done by that is extraordinary. So you've got influencing interest costs, which is where the Fed sets the target for short-term interest rates, and these rates influence all other interest rates in the economy. This includes the rates the Treasury pays on new debt, and everything else. If the Fed raises those interest rates to fight inflation, the cost of the national debt is then going to go up. Now, also, the Fed will buy and sell US Treasury securities on the open market. And these purchases will put money into the financial system. As a result, the Fed then holds a significant portion of the national debt as an asset on its own balance sheet, which is then why we have an, relatively speaking, artificial economy in the United States. But also, to be fair, that's a global thing, not just the Fed, but I'm using the Fed as an example here. But it's just a constant borrowing cycle. I tell you what, it's a little bit like a smaller version of the global economy. How UK borrows money from the US, who borrows money from Iran, who borrows money from wherever else, Russia. Just as an example there, theoretical, of course. But everyone borrows, and everyone borrows and borrows and borrows and borrows, and they're all borrowing money off of each other to pay the other ones back, and it's just a constant borrowing cycle. Well, that's actually quite similar to what happens within a country as well, but on a smaller scale, and especially in the US and how their economy is set up, how their government's set up. So think of it like that. Now, the next thing is deficits. And deficits widen. And then after that, you obviously have the political pressure, which increases. So the Fed isn't just managing inflation, okay, in a nutshell. It's not just managing inflation, it's managing credibility. And 2026, 2026 kind of besides the point. It doesn't even matter what year it is. Credibility is everything. And especially now more than ever. Now, the key insight here to really consider is that markets don't move on rate decisions anymore, right? Well, now, 10 years ago, even actually, I'll tell you what, not even 10 years ago, think about 5 years ago, the markets used to absolutely surge on rate decisions. When I say 5 years ago, well, 2025, 2020 was COVID. Do you know what, guys? It's probably not 5 years ago. It's probably over that now. Yeah, crazy how quickly time goes. But thinking about it, it probably was more closer to 10 years ago. Makes me feel old. But yeah, 10 years back, rate decisions themselves, they used to surge markets. You know, a Fed event used to surge the pound against the dollar 170 pips. You know, USD CAD on a Fed used to move 100 pips. Easily. That was a relatively, a relatively normal one. Sometimes it'd be way more than that. That was just on the rate decision, because the rate decision itself was what affected the market's landscape, the investor sentiment. That's what they cared about. But they don't affect them at all anymore. What affects the markets now is the guidance, the tone, and what's not said in the press conferences. So that is one of the new ways of economic policy and moving forward in 2026. That's what we need to be thinking about. What have they not answered? What have they dodged? And I've tried to instill this in you as well over the course of probably even longer than just 1 year, but I have tried to instill this in you to focus very much on the press conference, on the tone of voice that they're using. If it sounds negative, if you don't understand economics and you're listening to a press conference, if it sounds negative, it usually is. Just use your use of the English language and you will be able to decipher a fair bit of it just by tone and what's not said. So let's think about now systemic stress on our financial markets as well. And this is with bonds and debt predominantly. I'm going to take a pause actually just to see. Yeah, you're absolutely right about that, James. Yeah. He is an expert dodger. That is absolutely right. So let's think about bonds then. Bonds are the part of the market that most traders will ignore until they are forced to care about them. But you should not. You should not be ignoring them at all. Bond yields rising will equal capital demanding compensation for risk. And bond yields falling will equal fear, slowdown, and intervention. Now I want to go into those. Okay? Because bonds rising, equating to capital demanding compensation for risk, means when investors see more risk through inflation, defaults, or uncertainty, they demand higher interest payments, which is the yield on new bonds. This then pushes existing bond prices down, and you have an inverse relationship to make their lower yields attractive enough for new buyers, signaling that capital, money, is getting pickier and wants a bigger paycheck yield for lending it out. Okay, so just remember that. Try your best to remember that. In terms of the bonds falling, which is through fear, slowdown, and intervention, when a bond yield decreases, it generally indicates that fear and economic slowdown or intervention, and this is predominantly through one of two reasons. You've got increased demand for safety. You've got anticipation of lower interest rates underneath the fear and economic slowdown. So the increased demand for safety, let's think about that one. Government bonds, and especially those from stable countries like US Treasuries, are considered safe haven assets. So when investors anticipate an economic slowdown, they move their money into those safe havens, driving up the price of the bond and consequently pushing their yields down. Right? So if we then look at the 10-year government bond currently trading at 403, right? Let's go up here to the weekly. Let's go up here to the monthly, actually. Can we look at the monthly? Let's have a look at the monthly time frame. Look at the monthly time frame at the moment of where we are. In 2019 and 2020, we were down all the way down here. Before that, in the subsequent years, 2012, 14, 15, 16, 17, we were hovering around 216. And then we were pushed right the way up here, which is where we've now stabilized. Now, if I am a technical trader, which I am partly, and I'm looking at trend continuation patterns, and I'm looking at this monthly chart. Well, all I can see here is the big first wave, which is then at the end with a pennant, which is then a very strong bullish trend continuation pattern. Now, make no mistake, in 2026, if we see any real signs of trouble, so not a quietly, what's the word I was going to use? What's the word I was looking for? Recession, sorry. Yes, recession, that's the word I was looking for. If there are any more significant signs of recession and economic slowdown, or the AI bubble bursts, which I don't believe it will in 2026, I'm not saying that, but if they do, this will continue heading up. And we will finish 2026 with the US 10 years either up at the previous highs at around 5.0, 503, or above, or even higher. Yes, or even higher. So there is that as well, to contend with. Now, in 2026, bond markets are going to be the referee. If yields spike, central banks are going to lose their freedom. They're going to lose their political power. And to a certain extent, they will fall. If yields collapse, then growth fears are going to dominate the markets. Every market crash you've ever seen started with the bond markets whispering before the assets screamed. Every single one. So the signals are going to be in those bond markets, and I've said in the past I wanted to do some more focus around fixed income, because I trade the fixed income markets, but never something that I usually do, simply because fixed income markets on the CFD side of things are, or never were, historically a major trading asset. But as I've come to realize, they are now available, I think, on most normal CFD brokerages. So if they are, I want to start making more of an effort with them. I mean, even just from an analysis point of view, they're very, very important. So I think that's something that we're going to look more into over the year ahead as well. So, moving on. Let's think about the housing market. Right? Another major economic indicator of where we are going and what we're heading in. I read an interesting article. It was a couple of days back, and it was all about how the lowest in the projections from whoever it is that does those projections. I can't remember off the top of my head their name now. I've got so many different names and analogies and all sorts from various data reports that I've read through and compiled for today, actually, as it happens. I can't remember which one it is, but the major one that measures global forecasts in housing purchases says that there will be the most reduced number, or the least number ever of new home purchases since some ridiculous age, like when the damn thing was starting out, or decades ago. Decades it's been. And that nobody in, I think it's the generation under me, actually, so the sort of 5-year period beneath me. So I'm 35. If you're 25 to 30, let's say, you have next to no hope in the traditional method of home purchasing. So that is, making enough money yourself to then purchase a property and own a property. You have no hope of doing it. Basically, which is savage. I mean, that was from the US in particular. Okay, so I'm not talking about the UK, but frankly, I've seen what things are like in the US and I've seen what things are like here in the UK. I would say the UK is even worse. So I would hate to see those numbers from the United Kingdom and what the projections look like for us. So it's quite scary, isn't it? You know, it's certainly quite scary. Think about my son, you know, or you know, my missus two boys. I say our three boys, and obviously, you know, they're not technically mine, but they are. They might as well be. But you know, our three boys. The chances of them ever buying their own home through the traditional methods without parents' help is almost impossible. They would never be able to do it here in the UK. Local income versus what they need to live. I mean, you can get a spare room in the city now. We were looking at Rightmove actually, just for a bit of fun. Me and the missus, we're looking at see what spare rooms are because Sammy's coming up for uni age. You know, not now, but you know, a couple of years time, and we're considering things like this. And a spare room in the city is about 1850. Yeah, and I'm not talking about penthouses here, guys. I'm talking about a spare room. A spare room. You know, and you're looking at 1,500 quid to 1,500 to 2 grand a month for a spare room in the city. And I mean, it's impossible. You say London is crazy, right, James? And London is crazy. London is crazy. But how about this, right? How about this? My folks live down in the New Forest area, right? It is not a wealth area. It does rank very high in terms of housing prices versus local returns in terms of jobs and stuff like that. But it is not a wealth area. I would not classify it as a wealth area. It's kind of middle class, working class area. A spare room down there, as it happens, are now averaging at 900 to 1,000 a month. Down there. I mean, there is nothing down there. There's fields and horses and lots of farmland and stuff. I mean, who in their right mind are making up these prices? 800 to £1,000 for a spare room in a house in a field? I mean, there's a systemic issue in the world and in our nation, in the US. I mean, in the world, there is a real bloody problem with where things are going. It's gone too far. It has gone too far now. But yeah, crazy. Anyway, I could preach on about that for forever. But ultimately, let's get back on track here. There is a housing crisis. It's a slow motion crisis. It's not the excessiveness of 2008, but it's nowhere near a healthy state. We are like, I would say, another year or two away from 2008. We've got massive behavioral changes, massive affordability changes. People feel poorer, and so they don't need to lose their job to change their behavior, right? They just stop spending. So it's an important one because consumer weaknesses don't crash markets overnight. What it does is it erodes the earnings quietly. You will have, you know, 1 month where earnings will be great. Then you'll have another periodic trend over a quarter, which are all in the red. And then you'll have another one which is great. And then you'll have another couple which are poor. And then you'll have another good one that's great. It makes you think, oh yeah, things are all right. But it's only when you zoom out, and I just drawn upon what I said at the beginning of the session today, it's only when you draw out and you look at the long-term trend and then the potential projections of where we're going, that you actually take a step back and you're like, this is a huge bear trend. It's a huge bear market, a massive one on a huge scale, global scale. So that's why I thought it was quite prudent to, or not prudent, appropriate, sorry, to name this section the slow motion crisis. Because it's not like an overnight thing where the markets are tanked and we're all scattered, we're all running to try and recover what we can. It's not like that. It's so slow, you don't realize it day to day, week to week, not even month to month. But it's only by zooming out, looking at it from a yearly perspective, that you see that things are actually heading down and down badly. So there is that, that is going to shape landscapes in 2026. We are going to see that continue in 2026. As inflation cools and fiscal policy starts to loosen, or continue to loosen, let's say, we may see a little bit of a bounce back, but we're also going to be stuck in this situation where governments are charging businesses so much to operate. The businesses are going to keep on rallying their costs, because you have to think, right, in a high inflation market, businesses suffer a little bit, but really it's me and you that suffers the most. The working class, man. Look, I'm not even going to put myself in that. But it's going to be working class folks. It's going to be my parents. My parents will suffer. My missus will suffer. And it's all the working class folks that are gonna absolutely suffer. If you're an established trader, yes, you're gonna be paying a shed load in tax, and you're still gonna get stanged somewhere down the line. But you're only gonna pay that tax when you withdraw your money. So if you can live very frugally, and you can be very humble and responsible, then you can weather the tax tight storms, of course, until the taxes come down and you have a more sustainable way to withdraw your capital. I've withdrawn a lot of capital actually over the course of my trading profits this year, simply down to the fact that this well, it's living expenses. It's living expenses. I won't beat it around the bush. I'll be bloody honest. I mean, this business is in its infancy. It does not make me a livable income. It doesn't make anyone a livable income. So I live right now. I've lived the last 3 years of the trading profits from the account that you guys see. That you guys are with me on trading every day. So, and I've had to pay some extreme tax, some absolutely mental tax rates on that. But it is what it is anyway. I'm not going to start crying to you about that. I've already shed enough tears over the tax prices. Not today. But anyway, yeah. So things are in a bit of a shit state, and I don't think it's going to improve anytime soon. That's going to shape political landscape. It's going to shape geopolitical landscape. It's going to shape our economic policy landscape as things continue. So we'll just have to see how that one kind of plays out, as we always do. Now, the other thing, of course, we've got war, geopolitics, we've got energy shocks as well. Geopolitics doesn't need any escalation to matter. The uncertainty in it is alone enough, right? The continuation of the range in the microstructures that we've been looking at in the markets at the moment, so much of that is just because it's so uncertain. We live in incredibly uncertain times. It was only, I don't even know how long ago, a week ago, where Putin was saying about going to war with Europe. I mean, we would squash him, but it doesn't make a difference. It just doesn't. It doesn't make a difference. Who wants war? Can you even imagine a war like that with NATO? Imagine being alive in war times, like proper war times, where multiple nations are involved. You can't even imagine it, can you? It's horrible. I pray the day never comes, but I mean, we've never been more close than we are now. So there's that to contend with as well. I'm not saying it's time to start prepping and gathering up survival goods and stuff like that. No, I'm definitely not. But what I am saying is there are billions of dollars in the market that are considering those situations. That's what I'm saying. And the uncertainty will shape the assets we trade. Now, the other thing I wanted to go into this afternoon, well, even this morning, I guess I should say, is the energy transmission mechanism. You think about energy markets and how they feed into inflation, central bank hesitation, bond yields, things like corporate margins. There are a lot of key transmission channels. So, energy transmission mechanism basically describes the various causal channels through which changes or risks in the energy sector will influence the broader financial system and the real economy, and vice versa, of course. But you have price and volatility. So, fluctuations in energy prices like oil and gas, for example, can trigger price volatility in other financial markets like stock markets and commodity markets. And that creates things like chain liquidation, where risk spillovers, extreme, which cause extreme, risk events and stuff like that. I'm not talking about black swan events, but massive, massive amounts of bids or sells in UK Brent or US crude can then affect the Canadian dollar, which then affects the CAD 200 or whatever. You've got the cost of capital. You've got liquidity and credit risk. You've got investment in financing channels as well. Think about the market reports that I did last year and the interests. What was it? The sector by interest, where I outlined the spend of hedge funds inflow on various sectors. How many times did we come up against renewable energies? Right? That was like number one, number two, or number three for months. Absolutely months. And every single weekend we would see another 1.8, 2.4, 3.6 billion dollars invested into renewable energy. So that's another thing we need to think about this year as well, especially with the ever developing climate change situation. I'm not sure if you're all on board with that. Of course, nowadays I can't believe I'm even saying that, but climate change seems to be a political topic more than an environmental one at this day and age. I'm not looking at you, Trump. Don't worry. We've got commercial profit taking and distribution. Now this is going to be your edge, guys. Okay, aside from patience, commercial profit taking and distribution is going to be your edge. Now in the markets, commercial distribution is referring to the strategic selling of large blocks of securities or commodities. And it's going to be by the big institutional guys. Or, as we have come to know them as smart money. And these entities are frequently employing a contrarian strategy, and it's called selling into strength to realize profits when market optimism is high and positive economic data is driving prices up. So you got to think about, the large corporations, the manufacturers, the institutional investors, whose primary activity is often related to the underlying physical commodity or asset. It's not just, speculative trading or whatever. For example, their trading is often tied to hedging actual business risk, such as managing commodity price fluctuations and stuff like that, or like energy market price fluctuations, for example. So I'll tell you what. Let me say something that changes how you see the markets. Okay, markets don't ever reach a top because they are overbought or overvalued or whatever. They top out every time because someone is getting paid. Every single time. So yes, we use our points of liquidity and stuff like that, but when we use those points of liquidity and we see a market reaches them and we see the big knee-jerk reaction that we've seen a million times over, it's because someone is always getting paid. So we can use this information to our benefit. You know, having a continuing your study of commercial profit taking, distribution, liquidity flow is going to be now more important than ever before in our markets with everything that's about to take place, with everything that's going on. So try your best this year not to be constantly plugged in to all of the noise. Simplify things. Understand why the markets move, which I hope I've tried to get into enough today. And it is going to be a massive benefit to you over the course of the next year to no end. Obviously, you want to be keeping your eye on where Fed policy is, where the BOE is, of course. You want to be focusing on your important G8 currency, G8 countries, central banks, central bank policy, your CAD, your yen, partly Swiss, Australia, US, UK, Eurozone. You want to have a good, you want to have a good grasp on what's going on around them. But really, it's going to be about where the commercials are, positioning appropriately, and continuing to do what we do. You want to be looking at where sellers are consistently stepping in. You want to be thinking about where the pullbacks are getting aggressively bought. You want to be thinking about where the momentum's heading, and particularly where it's died. And 2026 is going to be a year of multiple legs. It's not going to be one clean trend in one asset. It's going to be very much, I believe, very much the same as 2025, which is a period of sporadic buying and selling that we have to navigate to the best of our abilities. So we need to be able to adapt. We need to be quick. We need to, and I'm kind of saying this to myself as well here, we need to be more adaptable than we have been before. And what I mean by that is I really want to make more of an effort this year in trade management over and above just a simple pending order, set and forget. Even though I'm very, very impressed, very happy, even proud, I would say, of my trading performance this year, there was a lot of money that was left on the table. And I think there was a lot of money left on the table because I wasn't quick enough. I wasn't able to adapt fast enough with the change in price movements as a result of just having a bunch of set and forget trades. So this isn't about changing strategy. This isn't about changing market understanding. This is simply about being possibly a little bit more hands-on. I think it was a realization having that natural gas order, that natural gas position. I really do. Because there were so many opportunities where we ended up taking a fixed trade at a 1 to 2.5 and the market continued going another 10x return. And yes, it's not always, it's not always going to be suitable. Lifestyle gets in the way and stuff like that. You have to consider things like that, family as well. And I'm not necessarily talking about spending loads more time at the charts either, but it's just about having a little bit more of a hands-on approach rather than banging out a bunch of decent orders, decent set and forget trades, and then rocking up the next day and seeing what happened. Just a little bit more of a human touch, I think, is going to be required in 2026 as things continue to tighten. Now, we have to discuss a couple of things in the FX themes as well. We have to think about monetary policy divergence. Okay, thinking about the US dollar safety bid. Now, the Federal Reserve is expected to continue cutting interest rates towards, what did they say? Neutral rate, wasn't it? Neutral rate of around 3.25 to 3.5% in 2026. That's their dot plot. And now this contrasts with other central banks like the ECB and the BOE, which are perceived to be closer to the end of their easing cycles or even considering hikes, narrowing the yield advantage of US assets generally, which weighs on the dollar. Right? So that's a really, really important one there, guys. Okay? That's not just words. You really need to think about that. The US dollar's always had the bid advantage, let's call it. But if the US in its current setup needs to continue reducing rates on its way back to its 2% target, and they're going to be cutting rates all year long, down to around 3.25% in 2026, with the likelihood of the ECB or the BOE, which may need to end their cycles altogether, or as it says in the quote that I got from FX Street, saying that they may even need to consider hiking, then that's going to be narrowing that gap hugely. Is the US safe haven reaction going to still be the same? Or will it be the end, temporarily at least, of the USD being a safety net? There will be a shed load of money flowing out of the US dollar as that weighs on the dollar, and the dollar will be losing its value. And will it be going into something else? I'm not saying it's going to go into the pound, because that's a bloody risky one as well. But we may see the rise of the euro. It may be the euro's time. I mean, we've seen the US dollar this year. Let's just flash over to. Let's just flash over here to the DXY. Look at the DXY now. 97.99. We're trading sub 100 yet again. We did make it back up here towards the end of the year, and now we're straight back down at the ground again. I mean, we've been trading down here at the lows predominantly throughout the entirety of 2025. Does this continue? Will we breach the low of 96 and head all the way back down? Could we see the DXY in 2026 trading 89.90, sub 90, down there? Now, if we look at the euro at the moment, there we go. Look at the euro at the moment. Look at the euro. It's had a good year this year. I think euro USD by the end of 2026, I would say that we're looking at 125. Euro against the dollar. Definitely. I'm really confident about that. We've also got US dollar versus the pound. Looking at the BOE ending its rate cycle, I don't think the BOE is going to raise rates. I mean, how could they, guys? I mean, they do what they're going to do what they're going to do, right? But I think the state of our economy at the moment, I think it would be economic suicide if they decided to raise interest rates. But if they did, God forbid, but if they did decide to start raising interest rates again, but even if they end the cutting cycle, I mean, cable's been trending up for a while now. It's currently trading at 135. I think by the end of 2026, we're looking at 145. Or 144, sorry, 144. 144 by the end of 2026 or above. We've also got things to consider like global risk mood. So if you think about the fact of what I was saying about the dollar's, safe haven qualities. Now, these tend to activate during periods of acute global stress or risk-off events, such as major geopolitical conflict or significant equity market correction. Now, in these scenarios, the demand for the US dollar often leads to temporary bursts of dollar strength, and that's regardless of the fundamentals or anything like that. But if we have the yield narrowing between the advantage of the US dollar being the safe haven, where's that money going to go? It's not necessarily going to go to the US dollar, it could go to euro, which would prop up the euro even more. Now, if all the safe haven cash flow goes to the euro instead of the dollar as a result of this, what's that going to do to the dollar's price? Well, the dollar's already going to be weighed on heavily by the monetary policy cycles. But if you also add in the fact that a huge amount of risk liquidity is going into the euro on top of that, the dollar could collapse. We could see a mega collapse of the US dollar in 2026, dependent on a number of huge factors, which I'm not going to say are going to happen or not going to happen, but I am saying that it is a very big possibility. And then we would have a mega euro cycle where the euro is really, really ramping up. We've got a lot of political uncertainty as well, don't we, in the US? The US fiscal situation at the moment is marked by deficits, rising debt issuance. We've got persistent long-term concerns. Now, the markets, I would say the markets largely absorbed this so far. If we look at the actual charts, the price charts. But is it going to absorb, continue political events such as the midterm elections in November 2026, with Donald Trump administration, leading the way? But I mean, that man is so crazy. It's scary that he is in the power of such a huge nation. And with everything that's going on now with Russia, China, and the developments further overseas as well, with Trump at the helm, I mean, God only knows. But all of that political uncertainty is going to be weighing heavily upon the US dollar. So I guess what I'm saying here is, be very, very wary of the USD this year. 2026 is going to be a very sketchy year for the US dollar. The other thing that I'm saying there is euro fragility that we have seen previously could be repaired. We could see a new reimagined euro, a renewed euro interest from mega commercial parties, where the euro is now being propped up by significant downward turns in economic, political uncertainty, with the USD, and the fact that the cutting cycles are ending with the euro. We may even see a rate hike in the Eurozone. That is definitely something that I think we could see in 2026. And we have rates coming down in the dollar. So we're seeing that sort of relationship become inverse to a certain point. Now, in terms of commodities, gold, what do you think that's going to do? With everything that I've just gone into, what do you think that's going to do? Hey, hello there, Matthew. Oh no, don't worry, buddy. Don't worry. That's absolutely fine. I do appreciate yesterday. I did say that I'd be on about 12 or 12:30. I decided to push up the time of the session today a little bit earlier, just because of the amount that we had to get through and stuff that I've got going on this afternoon. So don't worry at all. It's all being recorded and it will be uploaded to watch in full after the session's done. But good to see you nevertheless. James is saying 10,000 by the end of 2026. Yeah, man. I mean, yeah, why not? Why not? 10,000 by the end of 2026. Let's check out gold at the moment. Gold at the moment, guys. Look at it. Just look at it. Topped at 45.60. I mean, if I said 45.60 at the beginning of 2025, I think I would have been called an idiot, called a loon. People saying all over the place, I don't know what I'm talking about. I called 35 at the beginning of 2026, and that was about half of the. Well, it wasn't quite half. It was a little bit more than half, but man, did we get a huge finish to 2025. Extraordinary move in gold. But the thing is with gold, yes, it's going to have its pullbacks. Yes, it's going to have its pause phases. But if everything that I've just said comes to light with the US dollar, guys, we are looking at a massive continuation. This could just be the beginning of a trend. Okay, let me put something in perspective for you, okay? Let's imagine gold's come from there, it's come up to here. Let's say we have a little price action pullback. Maybe we come back down. First quarter of 2026, we come down 36.50, and we get ready for the next leg. That's just going to be a big bull trend. Do you know what else we saw this with? We saw this exact same thing, didn't we? Bit of a different fashion, and a lot less pretty. But we saw this, didn't we? It was the beginning of a trend. I remember back in the day when everyone was saying, you know, oh yes, we're all going to put all of our money into it. We're all going to put all of our money into it. And they put all of their money into it, all buying up here, thinking that was it, and bang, it collapsed. It did take everyone out. But then, a few years later, this just looks like a small hump in the road. And look at the damn thing. The damn thing rose up there to 126,000. Insane. Absolutely insane. Now, I don't want to use BTC as an accurate suggestion of what I believe gold is going to do. Gold is a very, very different asset. But it is the asset that rallies upon dollar troubles. And I foresee the USD in particular to have a lot of troubles and a lot of problems over the course of 2026. So let's buy gold. We do have to consider this in our trading strategy. We want to be very much bullish on gold over the course of 2026. And ultimately be prepared for that one. Certainly be prepared for that one. In terms of oil, we're looking for geopolitical premium, not demand growth. As the world turns its head in a different direction to original fossil fuels, the natural organic demand growth is not going to be the one for oil. But there is a lot of geopolitical uncertainty out there that directly affects the oil markets. So there is still going to be a lot of geopolitical demand. And I think that 2026, we will see a buyback in the oil markets. I certainly do. In terms of natural gas, I don't really have anything to say on that one, actually. Oddly enough, considering I've spoken so much about it over the course of the last month. But in terms of, I don't really do projections on natural gas generally. Natural gas for me is a cyclical asset. I like, trying to buy it at the right time towards the beginning of the winter season and getting out at the best price I can. And that will be the same. We will just rinse and repeat that strategy. So there's not much more to say on that one. Now, of course, there's the elephant in the room, isn't there? Artificial intelligence. Now, AI is a thing. It's real. But the markets, they aren't pricing reality. They're pricing the expectation. Okay? And I want you to really think about that for a moment. The markets, they're not pricing the reality. They're not pricing in where AI is right now, they are pricing in the expectation of what they believe it could be in time to come. I want to take a moment to explain a bubble, okay? Now, financial bubble will occur when an asset's price is driven way, way above its value by nothing more than speculation, which then eventually leads to a sharp collapse in the price. And when I say sharp, I mean flash crash style of sharp. Many, I would say, experts in the field, many very intelligent people, and some of which I actually really do consider to be extremely, extremely good minds, in late 2025 believe that artificial intelligence sector is in the middle of a bubble. And this is characterized by the massive amounts of investment and stretched valuations that ultimately are going to outpace the real returns, the real net returns. So there's, you know how I was talking the last few months about the fact that we've had the NAS 100 and the S&P just continuously be propped up by billions of dollars of AI investment into the companies. It was something like half of the S&P 500s, or maybe even actually probably a lot more. I don't know exactly. I'll find that out actually before I say a sweeping statement here. How many in the S&P? Okay, so it's 40% of 40% of the S&P 500 is tech. 40% is now technology. Bearing in mind, a couple of years ago, it was half that number. So now 40% of the S&P 500 is now technology, with a significant portion of that in artificial intelligence. Massive, massive money, guys. We're talking more money than we can even imagine. Okay. Now, this, in terms of how financial bubble works, you've got first of all, you've got displacement, and the displacement, which is a new innovative technology like AI, or a change in economic conditions like interest rates, creates new profit opportunities and attracts early investors. Then you have the boom. The optimism grows, prices rise, and the public is drawn in by social media, news, and FOMO, stuff, all of the good stuff that we know and love every day. The speculation increases and credit often expands to fund investments. Then we have the euphoria. Caution is abandoned as prices skyrocket. The greater fool theory, the belief that you can always find a buyer willing to pay more, takes a hold. Traditional valuation metrics are completely ignored and replaced by the narrative that this time it's going to be different. Then you've got profit taking. And that's the smart money. The early investors begin to discreetly sell their positions, recognizing that the price increases are unsustainable and market volatility may increase. It's at that point when you see the profit taking take place, and even though it can be small, it can be discreet, we will see it. You will see it. It's at that point that the bubble pops and we reach the bust phase. And that's the triggering of, and it will be a triggering event. Disappointing earnings, liquidity shock in the markets. It causes a sudden loss of confidence. Investors rush to exit the market simultaneously. This leads to sharp price declines, chain liquidation, and we see market crashes, the big crashes. Now, I just want to take a moment, let you think about that, let you digest that, okay? Because if we go over to the NAS 100, or, for example, the S&P 500, which actually even looks more exaggerated. If you think that the S&P 500 in 2020, from the beginning of 2024, in 2 years, has actually genuinely earned its growth, then I think I'm just going to say it. It doesn't mean I don't like you. I could like you very much. I'm friends with a lot of pretty nutty people, but I think you're insane. I think you are absolutely insane for the S&P to rally that much in 2 years. The S&P rallied the same amount in the previous. What was that? I need the bloody thing. I need more data. But anyway, what I can with definitively say, yeah, it's crazy. It's absolutely crazy. What I can definitively say is the S&P 500 has rallied just as much in the last 2 years as it has in the previous 6. That's what I can definitively say. And it's insane. It's completely insane. So it's going to end. And I think this is probably going to be my boldest statement of the entire thing today. The bubble, it is a bubble, and it is going to end. But I'm not saying the bubble is at the stage of it ending now or it's been completed. That's difficult to say at this moment in time. But it is going to end. And we will wipe off an incredible amount of these inflated gains when we realize that we actually cannot reach artificial consciousness, or the world simply says no to the big tech companies trying to do it. And it puts a halt. It puts a pause on the development of AI because of government policy, which I'm not saying is a bad thing. I don't know what I think about it at the moment. It could be great. It could be extinction level event. I have no idea. But yeah, the gains will be wiped out. So we also have that to contend with as well. James, I heard an interview with someone regarding AI and they said price has not even covered the investment costs yet. I have no idea, mate. I have no idea about any. I have no idea about any of that. But it's an interesting statement. Yeah, I just don't know. I have no idea. What I know for a fact, following the money trails, is that all of the major tech companies are all borrowing money from each other for investment. Nvidia's borrowing, OpenAI is borrowing money from Nvidia, Meta's borrowing money from OpenAI, and Google's borrowing money from Meta. They're all borrowing money from each other to prop their prices up and make it look like they're much more profitable than they are. So even just seeing that and just knowing that information, that's scary. Because then everyone is investing in a fake economy. Not to say that AI is fake and their progress isn't great. You know, they have clearly had progress, but things have slowed down. If you seriously consider what's changed from the moment we were released ChatGPT. Right, ChatGPT comes out. I can't remember when. When was it released? 2023? I can't remember. So don't quote me on that. ChatGPT was released. Let me just bloody Google it. Hang on a minute. When was ChatGPT released to public? Okay, 2023. Yeah, it was right at the bare ends of 2022. Let's just say beginning of 23. Okay, and so beginning of 23, Everyone found out about this new chat thing, and you could type questions into it and it'd give you an answer, and it was all really cool and everything like that. We all got very excited about it, right? And then, of course, you had a shitload of companies that were popping up all over the place with the tag AI. And all they did were copy ChatGPT's LLM, plug it into their own system, and rebranded. And so, in the last 3 years, okay, we're that was at 23. We're now at 26. In the last 3 years, can anybody give me any amazing, huge technological leap that we've had with ChatGPT, who are ultimately, the leaders in this? Because I can't tell you anything. I pay for access to some various like AI generating tools for social media, right? But the thing is, I could get just the same stuff out of ChatGPT, the free one. The thing is, ChatGPT, the only thing that's changed over the course of the last 3 years with it is the fact that it gives you responses faster. The responses are more accurate, a little bit more accurate. There's still a shitload of mistakes. I mean, you would never want to use it for work stuff. You'd have twice the amount of work to do. You'd have to ask it to do something, and then you'd have to check it. So it's useless for proper business. It's good for writing a letter to your dentist, or writing a complaint to Cadbury's chocolate because you got the wrong chocolate bar or something delivered. But it's basically useless for everything else. And so yeah, everyone has jumped on the bandwagon. This is what I'm talking about, though. This is exactly what I'm talking about. Everyone has jumped on the bandwagon. It's a behavioral thing. Everyone thinks that there's huge technological advancements in AI at the consumer level, but there's not. ChatGPT is the same as it was 3 years ago, give or take, give or take. But this is how the bubble's created. There's boom, and then there's euphoria. But I think very soon we're going to be in profit-taking stage. And when we reach profit-taking stage for the commercial institutions, it is not long afterwards where everybody starts selling because they're not seeing any real returns. So it's impossible to say when the bubble ends. It's impossible. I'm not, I don't have a crystal ball, and I'm not going to pretend to. But I do think that we're well underway with the bubble, and I don't think the bubble's got a great deal of life left in it, unless the only way that this does not, the only way that this, how can I say that? The only way that the bubble continues, the only way that we see continued interest and re-interest is if there's a major technological advancement, something new, something shiny, something that blows the world away. That's the only way this continues. At this current rate, though, with a bunch of people setting up AI companies and chatbots and stuff like that, or some new image generator, how long is that going to last? It's not going to last. Everybody gets bored, guys. Everybody gets bored. Doesn't matter who it is. So, yeah. So there's that as well. So look, as we come to a relative close on this topic, a couple of things. 2026, you want to be focusing on your patience. You want to be focusing on your context, the market's context. And above all else, you want to know when not to trade. This isn't going to be a year for easy markets, easy trading opportunities, and everything being real simple to understand. It's going to be confusing. It's going to need some serious navigation. You need to be patient. You need to be focusing on the context more than the conviction of the trades. You need to be focusing on when not to trade. Now, 2026, it doesn't need to be scary. Okay, it doesn't need to be scary. You don't need to be concerned about it. If you understand how the markets work in terms of the commercial repositioning, the stuff we do, we drive home every day, then the volatility is going to ultimately become your opportunity. And this year isn't about predicting the future more so than it is about being prepared for it. We just need to have a good, thorough understanding of the potential for what could happen out there at the moment, the things going on around the world, and just being aware that these things are happening regardless of what we feel or believe. They are happening. This is all fact, and this is what's going to be shaping the market's landscape throughout the year ahead. So I hope at least that you guys who have joined me on this journey today, this morning, have a bit of a better understanding about what's up and coming in 2026. And you can use this to be a little bit more prepared for it. Of course, I am going to be here almost every day throughout the course of 2026, apart from obviously holiday seasons, to navigate it with you. And this session, of course, has been recorded. It will be saved and uploaded, so you can access this as and when you need to as well. But I hope you have enjoyed it, guys. I really do. I hope you have enjoyed it. I hope there's been something in this for everyone. James, well done, Max. Brilliant stream. I know it's hard work talking to yourself for an hour and a half. Do you know what, mate? You're not wrong. No, I appreciate it, buddy. I appreciate the feedback. I'm glad you enjoyed it. And yeah, I do wish you all, and I speak to those of you who are with me right now, and I speak to everyone who's going to be watching this session over the course of the next couple of days and stuff. I do hope it comes in handy. Like I say, there's a lot going on around the world at the moment, and it is very uncertain times. But with patience, having just even a little bit of an understanding about what's coming, the more prepared you can be, the better it's going to be, the better the outcome's going to be. So take care of yourselves, everybody. It's been an absolute pleasure being able to provide this to you today. I hope you all have a wonderful New Year's as well, of course. I know tomorrow's New Year's Eve, so have a fantastic time, whatever you decide to do, and a fantastic day on New Year's Day as well. That will be it from us here at the UTC until January 5th, which is next Monday, where we will be at 100% capacity. That is daily sessions, all the good stuff, workshops and everything back up and running, and at that full capacity. So have a wonderful rest of the week. Have a wonderful, happy new year, and I look forward to catching up with you then. Take care, guys. I'll see you later. Bye-bye.